Essentially, you are evaluating Nestle. Okay, you are going to follow the framework, and let's just read this. The phase one is defining a purpose for the analysis. The analyst articulates the purpose and context of the analysis as isolating the factors that have driven the company's financial success and assessing their sustainability while delineating and understanding the risks that may upset the sustainability of returns. So in simple English, we are saying whether this is a good long-term investment or not. So whether I should buy Nestle stock or not for my portfolio. And obviously this is not with a trading intent, this is with a long-term investment intent, and to do so you need to figure out whether the cash flows and the earnings, are they sustainable, will they keep growing, how is this company doing relative to competition, and so on. So that's the purpose. What do you do in terms of data collection? Here it's simple. A ton of information is available on the Nestle website, so you go and download all the recent annual reports and whatever other data there is. The bulk of our exercise today is going to be phase 3, which is process the data, and phase 4, which is analyze and interpret the processed data. Specifically, we will revisit our good old friend DuPont. I hope you remember that. So we are going to look at the full form, the 5-segment form of DuPont. Do you remember what that was for? So that was to look at where is our return on equity coming from. So a company might have good ROE, but is it coming because of financial leverage? Is it coming because of good use of assets? Is it coming because of high margins, profit margins? So this DuPont allowed us to decompose the various components of ROE. So we'll do that analysis. Then we will look at the composition of Nestle's asset base. So that essentially means if we do a common sized balance sheet, what percentage of the assets are in what category. We look at the capital structure. Why might we want to do that? We want to assess the long-term solvency or riskiness. A company with a lot of debt in the capital structure will be more risky than a company with less debt in the capital structure. So that's one point. Another point might be that what is one possible reason for high ROE? It is high leverage. How do you figure out the leverage? By looking at the capital structure. So that is a comment here. A study of the company's segments and the allocation of capital among them. Any large company will have multiple business segments. A good analyst needs to understand what are the different segments, what is the profitability of those segments, how much is the company actually investing in those various segments. Is the company spending more money on the highly profitable segments, or is it putting money down maybe less profitable segments? So for a large company like Nestle, we need to do that. The examination of the company's accruals in the reporting as they affect earning quality. So this is a very fresh level 2 concept. Just because you see earnings growth doesn't mean that that's good earnings. You need to look at what's the accrual ratio in there. A possible area of concern would be a high accrual ratio or an accrual ratio that is growing. Okay, and then you study the company's cash flows. So always in any analysis, cash flow is significant, and their adequacy for a company's continued operations and strategies. And then finally, decomposition and analysis of the company's valuation. So this will be a good segue into equity. End of the day, you do all this, but you still need to verify that, okay, is the company, what's the company valuation? Is it, you might figure out all this is good, but the company might already be overvalued. Okay, so in which case you don't invest. So this is a critical part of any analysis. Okay, so these 7 or 8 items are what we are going to go over. Okay, so here is our DuPont. I hope I'm not going to go over this. I'm just going to say it. So your return on equity in our extended form is a combination of tax burden, interest burden, and so on. I'll just start from the right. Financial leverage is a measure of how much leverage or how much debt is in the capital structure. A high leverage would do what to return on equity? It will increase. In fact, for any of these components, a high number increases ROE, but a high leverage means ROE is higher, but at the expense of taking more risk. So a high number here is not necessarily great. What about a high number for revenue over average assets? This is a measure of what? This is a measure of how efficiently we are using our assets. So a high number shows that the company is efficient. EBIT margin, this is another number that shows us our operating profit margin, which is good. What does interest burden tell us? What does a high number tell us? A high number tells us that we have low interest. I find these two terms very confusing, so I hope you are clear about this. A high number for this interest burden means we really have low interest, right? So a high number for this ratio means that EBT over EBIT is high. When is that number high? That number is high if the interest part is actually low. So low interest would mean that you are getting a higher ROE, and a high number for the tax burden is actually means that you have low tax. In some books, they write this as 1 minus the tax burden or 1 minus the interest burden, but you need to know that this is the formula, and the ratio being high is a good thing. So in the case of Nestle, what is interesting is Nestle is a big company that has made several acquisitions. Some are consolidated, so this now ties in with our discussion on intercorporate investments. So Nestle has some companies that are treated as associates. And do you recall what accounting system we use for associates? We use the equity method. And now do you recall what we do with the equity method? What will the equity method do to these ratios? Yeah, so the equity method, let's say that Nestle has a 30% stake in L'Oreal, which it does, as we'll see shortly. 30% stake typically means we use the equity method. Equity method means that we simply do one-line consolidation where we take Nestle's share of L'Oreal's profits. So it's going to just boost net income. So that will make, will it boost the EBIT margin? Yeah, because actually that is all added here also. So it is going to make the margins look better. But as an analyst, you are concerned with the core Nestle. Okay. So I'm not going to go through all the details, but what is the adjustment that you think you need to make? The adjustment is you remove the impact of the equity method income and investment assets. So for example, if you recall, what will happen on the asset side, on the balance sheet? So on the income statement, you are simply boosting your income by only taking the associate's income, but not adding on to the revenue. So the profit margin seems higher. Okay, remember, all this part can also be written as what? So that was simply the net income over revenue. So because of the equity method, this is being boosted, but this is the same. When we say adjust, make an adjustment for the equity method, we mean bring this back down and reduce the impact of equity method accounting. What do we do on the asset side? On the asset side, again, we have a one-line consolidation. So we don't show higher liabilities, we just show higher assets. So without going into details, all I'm going to say is that we make an adjustment on the income statement and we make an adjustment on the balance sheet. Okay, so what we then see, we want to see, why are we doing this? Because we want to see whether if Nestle has a high return on equity, is this coming because of Nestle's core operation or is it coming because of the favorable impact of the associates? Okay, so when we do the adjustment, here is what let's say we are the analysts here. The return on equity overall, the top row is overall, where it's Nestle with the associates. Let's take 2007. The ROE is 21.25%, which looks pretty good. Then after removing the equity method impact, does it make sense that the ROE becomes lower? Yeah, it is lower, which makes sense. But as an analyst, you are happy to see that the decline isn't too much. Okay, and the same in previous years. So what is your simplistic conclusion from here? That, okay, equity method is being used. That is having a slightly favorable impact, which is to be expected, but it's not like most of the ROE is coming because of the investment in associates. Okay. And anyway, so case these are just the core numbers pulled out, but this is the core point, and the judgment from here is also important. Okay, next, asset-based composition. So does this look familiar? In level 1 we studied the common sized, this is the balance sheet. So how do we create a common sized balance sheet? Everything as a percentage of total assets. So notice this is just a rounding issue. So do you see something interesting here? Look at the percentage of intangibles. The intangibles are pretty high. What does that imply? What's generally the biggest intangible is goodwill. Okay, so what does this imply? This implies that maybe a lot of acquisitions are being made and Nestle is paying a fair amount for goodwill. So then a next thing to do is looking at the investment activities to see what's going on. And you notice that a lot of the investment activity throughout the years is spent on acquisition of businesses. So this also tells us a little bit about Nestle's strategy, that they've been spending a fair amount of money on acquisitions. And if you look at acquisition as a percentage of total investing activity, in general, that's like 50, 70, 60, fairly high in recent years. Okay, so this can be, we'll study this in more detail later, but as in this isn't necessarily great, it's not necessarily bad. Okay, so we can't draw too many conclusions from here. Okay, next we look at capital structure. So what is the core point here? Again, on the common sized balance sheet, we are now looking at the right side. So we are looking at the liabilities and equity. So is this a concerning situation, or does this look okay? As this is 2005, 6, 7. So time is going this way. What's happening to from 2004 to 2007? If you look at just the financial liabilities, what do you think other long-term liabilities are? This generally refers to pension liabilities. Okay, and these are the financial liabilities. Notice that pension liabilities seem fairly stable. What about financial liabilities? So is this a good sign? Yeah, so it's decreasing its financial leverage, which is favorable. Okay, but notice earlier that despite a decrease in financial leverage, the company had maintained a decent ROE, right? Normally, if financial leverage is going down, what would that do to ROE? It should have caused ROE to go down. So how did the company still maintain a decent ROE? How do you think? If your leverage is going down, yeah, then you are either increasing your margins or you are increasing your asset utilization, basically making your company more efficient. How do you make a company more efficient? If you look at, I think the key points over here, if you look at things like days DSO, what did that stand for? This is how well you are managing your receivables. Is a lower number good, higher number good? So the company has managed to lower its DSO, which means it's collecting money faster. What about days on hand of inventory? There again, the company has been reducing those numbers. What about days of payables? It's increasing them. So overall, the company seems to be managing its working capital better. Yeah, so the question or the comment here is that equity is relatively high. So I think another way of phrasing this question is, this is not explicitly mentioned in the case, but the question might be, is this company operating at the optimal capital structure or not? So that as an analyst, there is no limit to what you can look at. So you can do a little more research and see, can the company increase its valuation by maybe taking on more debt? Okay, the company used to have more debt. Okay, so you can research why this was reduced. Okay, so fair question, but don't have a crisp answer, but it's a good observation. Okay, then next is a segment analysis. Interesting and confusing aspect of many large companies is that they define some segments geographically and some segments based on the type of business or function. Okay, so there seems to be a matrix sort of system, and that's, having seen some large companies, this happens all the time. So you can't just add up all these and say that's 100% necessarily. Okay, so anyway, what we are seeing here is the EBIT. So this is the ratio of capital expenditure percentage to total asset percent ranked by EBIT margin. So on the left, we are looking at EBIT margins. Okay, so that means what's your most profitable business? So looks like pharma is the most profitable business, and Nestle Waters seems to be the least profitable. So at least from an analyst perspective, you would hope that more investment goes into the more profitable businesses. And then we aren't going to get too hung up on this particular piece, but you just need to know that a segment analysis is one important aspect when you are looking at a large business. Okay, so you can also then evaluate which segments should the company de-emphasize. So based on this data, you would like to, or you'd be happier if the company de-emphasizes which segment? Yeah, so you would like that they de-emphasize Waters. But if you look at ratio of capital expenditure percent to total asset percent, there is an area of concern here, that this is a relatively high ratios where the company, so if you look at capital expenditure to a total asset, there seems to be relatively high money spent here on the Waters business. So this would be an area of concern for you. Maybe it's new. So obviously when area of concerns come up, then you dig in deeper and figure out what's going on. Okay. Next material that we have just studied, accruals and earnings quality. So we do our calculations that we should be fairly comfortable with by now. So we are looking at how do we come up with a balance sheet accrual. So it's the change in aggregate accrual divided by the average net operating assets. Do you get concerned here or not? Yeah, this is an area of concern. If you look at the last few years, initially we were relatively low, then we go up. A, there is a lot of fluctuation. B, we have a couple of big numbers. So does this suggest that there might be some earnings management going on? There might be. So there is a concern, because if you have such a large fluctuation, there is a concern that there might be some earnings management. Normally you would expect the accrual ratio for a large, relatively stable company that it should not fluctuate that much. Okay, even the cash flow accrual ratio is pretty high. So accrual ratio is fluctuating. Question, are they managing earnings? Okay, so anyway, there are concerns here. If you have this concern as an analyst, what do you think your next step would be? What should you study next?
Look at the cash flow.
Exactly. So there's an issue with accruals. So obviously look at cash flow. Okay, so very good. So we do a cash flow analysis. Okay, so in the cash flow analysis, again, I'm skipping a lot of details. You can do all sorts of cash flow analysis material that you've seen in level 1 reading on cash flow. But a critical number would be the operating cash flow before interest, income and taxes divided by operating income. So your operating cash flow divided by operating income. Now, if you look at your cash flow from operations, just one testable point, versus you look at your operating income from the income statement. When you come up with your operating income for a company like Nestle, do you subtract interest to come up with your operating income, or is this before the interest expense? This is before the interest expense. With CFO, is interest expense subtracted before coming up with CFO? Yeah, actually it depends. Remember, Nestle is probably IFRS or US GAAP? IFRS, right? Only US companies follow US GAAP. So Nestle is out of Switzerland, so they follow IFRS. Do you remember what IFRS says about interest? Yeah, there is a choice. Yeah, so now if interest income has been subtracted to come up with CFO, then what should you do? You should remove that effect. If you are coming up with a ratio of operating cash flow to operating income, to make things symmetric, if interest is built into the CFO, you need to pull it out. When you pull it out, what will happen to CFO? It will become a little higher. But does it make sense to pull it out, since you are comparing it with operating income, which doesn't have interest? So to make things symmetric, you first check whether interest is here or not. If it is, you pull it out. And then you look at the ratio. So when you look at this ratio, does some of your concern from the previous slide get alleviated? Yeah, this looks pretty decent. Okay, so you saw some concern with the accrual ratio, but when you look at the cash flow from operations relative to the operating income, this looks pretty good. Okay, so that was the main point out of this part. You can also do all sorts of other cash flow analysis, but this is the core point. Okay, then what's the final point? This is more complicated than we would like, but the final point is, so overall things look reasonable so far, but is it good enough to decide whether to invest or not to invest? What's a core point to look at before you invest?
The relative valuation.
Exactly. So everything looks good, but it might still be overvalued. Okay, so in equity, we'll study this in a lot more detail, but we need to look at valuation. Now, just to make our life very interesting, Nestle has a 70% stake in a US company called Alcon. So if it has a 70% stake, then the consolidated financial statements of Nestle include 100% of Alcon's investment, but Nestle only owns 70%. L'Oreal, Nestle owns about 30%. The Nestle assets and liabilities are not consolidated, but we are doing the one-line consolidation based on the equity method. So conceptually, what we are going to do now is, if we just look at the Nestle stock overall, that Nestle stock and the price earning ratio represents Nestle and its associates and the consolidated companies. We want to see, and interestingly, the associates such as L'Oreal and Alcon both are traded as stocks on their own also in their respective markets. So we want to pull out the effect of L'Oreal and Alcon and then see what is the actual underlying valuation of Nestle. Okay, so that's quite interesting. So what's the first level data that we look at? We look at L'Oreal. L'Oreal is, I think, based out of France. So we'll also have three different currencies over here, which ties in with multinational. The presentation currency for Nestle, based out of Switzerland, is the Swiss franc. The currency for Alcon, which is a US company, is the dollar, and the currency for L'Oreal is the euro. Okay, so this just is as interesting as it can get. So what do we do here? The first thing we look at, and let's say this analysis is happening on 31st December 2007. We look at L'Oreal's share price. We look at the number of shares held by Nestle. So the total holding value of L'Oreal, Then we use the exchange rate between the euro and the Swiss franc. And since we are doing all our work in Swiss franc, because that's the presentation currency for our target company, which is Nestle. So what this is saying is that if we look at Nestle's total valuation, out of that total valuation, 28961 is coming because of L'Oreal. Okay, is everybody fine with that? Next, we do the same thing for Alcon. That's Alcon's share price. That's the number of shares held by Nestle. So Alcon's holding value, so Nestle's, the part of Nestle's total market value that is coming from Alcon is 36,499. What do you think we'll do next? So we'll subtract. So Nestle has a share price that's pretty substantial, 497.77 Swiss francs. So these are expensive shares. Looks like they don't believe in splits. Okay, and then what is 393? So this is the number of shares outstanding. So what is this number? That's the total market value of Nestle. Does this market value include Alcon and L'Oreal? Complete Alcon and complete, or just the part owned by? It includes these two numbers, right? So to figure out the pure market capitalization of Nestle alone, without the associate and without the consolidated company, that is this number. Okay, so interestingly also, the pro rata market value, 14.8% of the market value is coming from L'Oreal, 18.7 is coming from Alcon, and 66.5 is coming from pure Nestle. So Nestle alone is only accounting for like 2/3 of the total capitalization. So that's first level that looks interesting. Okay, so let's move on. Okay, now to make life interesting, Alcon. So what Alcon, remember, if we own 70, let's just imagine we are Nestle here, okay? So we own 70% of Alcon. So that means we consolidated Alcon. So to remove the effect of Alcon, what do we need to do? Okay, so here I'm just making a few remarks. First of all, on the side, Nestle owns 77.4% of Alcon. Alcon reports in US GAAP. So we need to translate Alcon's numbers from US GAAP to IFRS, and then we need to pull out the impact of Alcon from the financial statements of Nestle. The quick idea is this: for simplicity here, since we haven't covered equity, our valuation will be based on a price earnings multiple. Okay, so have we figured out the price in the market? That we did on the previous slide. So the price of pure Nestle we figured out. What do you think we are trying to do? Now we are trying to figure out the earnings of pure Nestle. Okay, and again, do you think it's easy to pull out the earnings of L'Oreal from the consolidated earnings of Nestle? Do they include L'Oreal's earnings? Do they include Alcon's earnings? So we need to pull both out. Is it easy to pull out the earnings of L'Oreal? Yes, because that is a one-line consolidation. Plus, if we look at the notes underneath the income statement, it is given that the contribution from the associate L'Oreal is this much. So we simply pull that out. Is it easy to pull out numbers for Alcon? No, so that we have to do some work. Okay, so what do? We look at Alcon's financial statements, which will be in dollars. Okay, now fortunately for us, all the reported numbers are, so in the sort of numbers reported, there isn't much difference between US GAAP and IFRS. But if there are differences, then you need to translate a US GAAP company into IFRS, right? So here we are not required to do that. All we need to do is the currency translation. So in the financial reports, we see that the operating profit of Alcon is converted into Swiss francs as 2300. Okay. And then so that's the operating profit. Then we are looking at all the other items that are contributing to profit but which are non-operating. So there is some gain from foreign currency, 11.2 in US dollars, which is 13.2 in Swiss francs. There is some interest income, interest expenses, other income. So the total after EBIT items, what do you think this means? So these are the items that are contributing to profit but are non-operating. So obviously we need to factor those in too. So that's 54.9. So this earning of 23,549, where is this coming from? This is the non-operating income plus the operating income. You add these two and you get this. Then you look at income taxes at the Nestle effective tax rate. So your estimated Alcon contribution to net income is this much. Okay, then the point is that is this entire amount shown in Nestle's income statement? Yeah, this entire, since it's consolidated, the entire amount is shown. But you also need to know, since we are pulling out 22.6% is not owned by Nestle though. Okay. So that 22.6 of 1759 is 397. So really the part of the income that can be attributed to Nestle is 1361. Okay. So I hope you're still with me here. Okay. Next. So what's the calculation of non-Alcon minority interest? So the point here is reported profit attributable to minority interest is this. If you look at the income statement of Nestle, Alcon is the major other company that has been consolidated, but there might be other smaller companies also. So what has been reported is 733 for all profit attributable to minority interest. The part that is attributed to Alcon related minority interest, as we just found, was 397. So non-Alcon minority interest is 335. Okay, and now the final part. If you are not following the exact details, not such a big deal. This part is important though. Nestle's consolidated earnings, where does this number come from? That's pure the consolidated income statement. You subtract L'Oreal's earnings. Is this easy? Yes. This is easy because it's equity method. You look at the financial disclosures, there you will see this number. So you subtract that. Then you subtract the Alcon contribution to the net income, which is this. So Nestle's standalone earnings are 8209 after the impact of Alcon, which we just found. So this is Nestle without Alcon and Nestle without L'Oreal. And then as we saw here, there are other smaller companies where there are also minority interests. This number that we found, we subtracted that too. So Nestle standalone without any other impact is this. So now we have the total earnings for Nestle alone, which is 7985. Okay. Then what do we do? Okay. So these are the market values. So the total market value currently of Nestle, looking at the number of shares outstanding multiplied by the share price, is 195,661. Where is this number of 36499 coming from? Here we are looking at the number of shares of Alcon owned by Nestle multiplied by the market price. That's this number. Same thing for L'Oreal, number of shares owned, and we did this on the first slide. Number of shares owned multiplied by the share price. So then this number is a plug. Okay, that's the implied Nestle only value. Okay. In the second column, we have this is the total earnings, consolidated earnings reported. Okay, and what we just found out on the earlier slide was the Nestle only earnings. So when we do this, what is the PE for Nestle alone? So the total price of market value divided by total earnings gives us a PE of Nestle alone of 16.3. Even though the PE of the consolidated Nestle is 18.4. But the reason this is 18.4 is because the relative valuation of Alcon and L'Oreal is high. Okay, so what we are noticing is that if we compare this 16.3 with other similar companies, then this is a relatively low PE, which you might not, let's say the market average is about 18, okay, for Nestle type companies. But if you simply looked at 18.4, which would be a high level, then it might seem overvalued. But when you pull out the impact of the associate and the consolidated company, then you notice that this is pretty good. Okay, and also, if you look at the market value of the total market value of Nestle, we just saw that 66% or roughly 2/3 is coming from Nestle, and yet if we look at the earnings, 75% are coming from Nestle. So the core underlying entity is looking good. All right. So based on this, and this was just an excerpt of all that is in the curriculum, but what I wanted to do here was give you a flavor for how we have utilized things like ROE, DuPont, segment analysis, a whole bunch of things from level 1 and level 2. And at the end of all this, we then do phase 5. So all this was phase 3 and 4, which is the bulk, the meat. And then what is your output? It's the report that you write. And I think this is a great report. I'm not going to read this, but I think in that whole case, don't do the 20 pages worth of reading, but just do the 1 page. I think those who are actually in this business will find it very useful. So read this. Basically, they have then summarized all the reasons for why Nestle is a good investment. And then next slide suggests some areas of concern. And the final recommendation is the analyst concludes that Nestle represents a good investment opportunity and recommends it as such. Okay, so I think this is pretty good.